Hello and welcome to Simplicity in Stocks. In the Indian stock market today, foreign investors are booking profits, domestic investors are trading carefully, and valuations seem a little stretched. Momentum stocks are in the spotlight due to the correction. But where are the real opportunities for investors? Well, they can be found in the ignored corners of the market. Some stocks are simply too cheap to ignore, not just because they have fallen, but because their fundamentals are solid. For those who are interested, here are 5 stocks that could be hidden gems in this market. These stocks may have been beaten down, ignored, or simply overlooked, but their business fundamentals tell a very different story. Before that, please note that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered here. Natco Pharma. Natco Pharma has carved a niche for itself in the pharmaceutical space, excelling in generics, oncology, and complex drugs. The company's first to file strategy in the US has been a game changer, helping it secure strong market positions in high value products. With a pipeline packed with niche molecules and biosimilars, Natco is gearing up for the next leg of growth. Yet, the stock is trading cheap at a current price to earnings ratio (P/E ratio) of 12, well below its 5-year median P of 26. The market is cautious due to continued losses in the crop science business and weak domestic formulations. But a recent cash windfall has given Natco the firepower to invest in high margin opportunities, including exclusive launches like Ozempic. The long-term picture remains solid, backed by a strong cash balance, a well-defined R&D pipeline, and its ability to scale up in limited competition segments. While near-term concerns persist, this just might be an opportunity hiding in plain sight. IDFC First Bank. IDFC First Bank stock is struggling because of persistent earnings misses and its continued stress in the microfinance book. The latest results in Q3 FY25 disappointed yet again with a profit of just 3.3 billion rupees and a return on assets ROA of a weak 0.4%. The stress in the MFI portfolio led to lower margins and higher provisions. Margins have also been under pressure due to interest reversals on NPAs and a lower loan to deposit ratio. Slower loan growth versus deposit growth is also a factor that is weighing in on investor sentiment. With all these concerns, the stock is hovering near its 52-week low as investors worry about asset quality risks, slower growth, and uncertain profitability in the near term. Despite all these near-term headwinds, IDFC First Bank's long-term story remains intact. The bank's non-MFI retail portfolio is holding up quite well. The management expects the MFI stress to ease early in FY26, which should improve asset quality and profitability. More importantly, the bank's deposit franchise remains strong. This provides a solid foundation for future lending. The company sports a relatively clean balance sheet and is also gearing its focus towards high-margin businesses. Indraprastha Gas. Indraprastha Gas IGL is a leading city gas distribution company that is supplying compressed natural gas (CNG) and piped natural gas (PNG) across the national capital region. It has a dominant position in the market with long-term gas sourcing tie-ups and a debt-free balance sheet. The company has been a key beneficiary of the shift towards clean energy. As cars and commercial vehicle manufacturers push CNG variants, IGL is expanding its infrastructure, adding more refueling stations and boosting its compression capacity. Despite this, IGL has been caught in the market's crosshairs, sliding about 24% in the last 6 months. It's trading at a price to book or PB ratio of just 3, a discount of 35% to its 5-year median PB of 4.7. Shrinking margins and policy flip-flops have spooked investors. The October-November APM gas cut forced IGL to rely on expensive LNG, which squeezed margins. Meanwhile, uncertainty around gas allocation policies and GST inclusion rumors only added to the selling pressure. Even after the partial rollback of APM gas to 51%, the recovery won't be instant. But the long term story remains intact. IGL is expanding its CNG and LNG network, betting big on cleaner transportation. A debt free balance sheet and steady infrastructure growth ensures it remains well positioned. If the company gets its gas mix right and pushes through the pending price hikes, then margins could bounce back in FY26. But with steady volume growth and a dominant position in NCR and structural demand tailwinds, the market may be writing off the recovery story too soon. Berger Paints. Berger Paints is one of India's leading paint manufacturers. 80% of its revenues come from decorative paints and 20% from industrial paints. The company has steadily expanded its retail network and strengthened its market presence with over 25,000 dealer partnerships. Despite inflation and an extended monsoon last year, it held its ground, particularly in the decorative segment, where strong volume growth in economy paints helped to offset pricing challenges. Yet it has faced its fair share of setbacks as earnings declined and demand remained uncertain. The entry of Grasim Industries and other heavyweight players has disrupted what was once an oligopolistic market, adding pressure on pricing and margins. But Berger isn't new to competition. Its robust distribution network, brand equity, and operational expertise have helped it navigate competitive challenges in the past. Trading at a PE of 48, the stock may seem expensive at first glance, but it is at a 31% discount to its 5-year median PE of 71. The long term story is intact. As the industry consolidates, established players with strong infrastructure will be best positioned to capitalize on new growth opportunities. Rising disposable incomes and increasing urbanization will drive steady demand for paint companies that can adapt to shifting consumer preferences. For long term investors, it's not about whether Berger will bounce back, it's just a matter of when. Sona BLW Precision Forgings. Sona BLW Precision Forgings, or Sona Comstar, is a leading supplier of automotive systems that is specializing in differential assemblies like gears and EV traction motors. While serving all vehicle categories, the company has sharpened its focus on electric and hybrid vehicles, designing high power density EV systems and fuel saving hybrid motors. The EV revenue of the company has jumped from 14% in FY21 to 29% in FY24. The company has a target of 50% over the next 2 years. It has set aside rupees 10 billion in capex over the next 2 to 3 years to achieve this. Yet the stock has faced near term pressures with weak demand in key markets such as the EU, US, and the off highway segment, as well as India's commercial vehicle sector. A slowdown in the EV transition, coupled with a model change at a key client, has further hurt the revenue of the company. Despite this, the long term story of the company remains intact. With 76% of its order book linked to EVs, it is well placed to ride the ongoing shift towards electric mobility. As EV adoption accelerates and the company leverages its global reach and strong customer relationships, it is well poised for solid long term growth. Markets can seem impatient, but smart investors know that cheap stocks don't stay cheap forever. Whether it's margin pressure, policy uncertainty, or short term demand issues, these stocks are facing headwinds that won't last forever. When the sentiment turns, businesses with strong fundamentals, market leadership, and long term tailwinds tend to bounce back fast. That being said, make sure to conduct due diligence and corporate governance checks before considering any stock. Happy investing.